The Treasury tried to stop this. It didn't work. Behind closed doors, in a market few Americans ever watch closely, a decision was made, a decision meant to calm the bond market, to quiet the fear building underneath the surface of the U.S. economy, but something else happened instead. Gold didn't fall. It rose, past $4,500, past $4,550, straight through $4,600. And now, the people who move billions of dollars for a living are asking the same question you're about to hear answered. What does gold know that Washington doesn't want you to see? Stay with this one. Because by the end, you'll understand why this moment may be remembered as the week the old rules stopped working. Welcome back to Precious Metals Intelligence, the channel built for those who prefer to understand the world a little before everyone else does. If you're new here, this channel exists for one purpose: to explain calmly and clearly what is actually happening beneath the headlines in gold, debt, and monetary policy, without the noise and without the hype. Before we begin, we'd genuinely like to know, where are you watching from today? Drop your city or country in the comments below. It always means a great deal to see just how far this conversation reaches. Every investor, whether new to the markets or decades into a career, learns a handful of unwritten rules early on. And nobody teaches these rules in a classroom. They are passed down through experience, repeated so often that people stop questioning them. And for most of modern financial history, these rules simply worked. This past week, 3 of them stopped working, all at once. The first rule is the oldest one people learn. When the world becomes unstable, gold rises. Conflict, tension, uncertainty between nations, these things have always pushed investors toward gold. It is viewed as protection, a safe place to put money when the world outside feels unsafe. Yet when real conflict broke out recently between major powers, gold did not react the way history said it should. Instead of climbing, it fell. Silver fell alongside it. For traders who have watched markets for decades, this was strange to witness. A veteran market analyst who has studied gold charts for 40 years admitted that this particular reaction broke a pattern he had relied on his entire career. Geopolitical tension used to guarantee a certain response. This time, it simply did not show up. The second rule involves bonds. For years, investors have been taught a simple relationship. Gold pays no interest. Government bonds do. So when bond yields rise, gold is supposed to lose its appeal. Why hold a shiny metal that earns nothing when a government bond offers a steady, growing return instead? This rule broke just as clearly as the first one. Long-term bond yields climbed to levels not seen in years. Normally, this would have pulled investors away from gold and toward bonds. Instead, gold kept rising anyway. The old relationship between yields and gold, one that traders relied on for years to predict movement, simply failed to hold. Analysts who study this connection closely point to a deeper reason behind the shift. It is not just about interest rates anymore. It is about debt. Massive government borrowing is now competing directly with a new kind of borrower, large technology companies racing to fund enormous infrastructure projects. Both are chasing the same pool of available money. Both are pushing yields higher for different reasons. And investors are beginning to realize that rising yields in this new environment do not necessarily mean a healthier economy. Sometimes they mean the opposite. The third rule is the newest one to break, and in some ways, the most important. For decades, when the United States Treasury made an announcement, markets responded with calm. Predictability was the entire point. A Treasury announcement was supposed to settle nerves, not create new ones. This week, the Treasury announced a surprise plan to sharply increase its buybacks of long-term bonds. It was meant to project strength and control. Bond prices did rise briefly, just as intended. But within a single trading day, yields crept right back to where they started, as if the announcement had barely happened at all. When asked about this reaction, a senior Treasury official brushed off the short-term movement, calling it noise within a thin, easily disrupted market. He expressed confidence that bonds would stabilize once broader fiscal plans were revealed. But confidence stated out loud is not the same as confidence proven by the market. And so far, the market has not fully agreed with him. 3 separate rules. 3 different corners of the financial world. Geopolitics, yields, and government credibility. All 3 cracked within the same short stretch of days. For most investors, 1 broken rule might be dismissed as an unusual event. 2 might raise an eyebrow, but 3, breaking together in the same week, is much harder to explain away as coincidence. What makes this especially uncomfortable for professional investors is not the breaking of any single rule. It is the fact that these rules have worked reliably for most of their careers. They were treated almost like laws of nature within finance. Predictable, dependable, safe to build strategy around. When laws like these begin failing simultaneously, it does not necessarily mean panic is coming, but it does mean something underneath the surface has shifted. The old assumptions, the ones investors leaned on without a second thought, may no longer describe the world accurately. And if the old rules no longer apply, the next question becomes far more serious. What new forces are actually driving the markets now? To answer that, the story must go beneath yields and geopolitics entirely, into the one number now shaping almost everything else, the debt itself. For decades, the United States Treasury followed one simple rule: be predictable, never surprise the market. Investors around the world lent America money because they trusted that nothing sudden would happen. No shocks, no surprises, just steady, boring, reliable behavior. That rule broke this week. The Treasury announced it would sharply increase how much it buys back in long-term government bonds. On paper, this looked like a technical move, something only bond traders would care about. But underneath, it was much bigger than that. It was an admission that something in the debt market needed fixing, and fixing quickly. To understand why this mattered, it helps to think about debt the way a person thinks about a loan. When someone borrows money, the lender wants to know the payments will be steady and predictable. If the borrower suddenly changes the terms without warning, the lender starts to worry, not because of the size of the loan, but because trust has been shaken. The United States is the largest borrower in the world. It owes more money than any other country in history. When it borrows, it promises stability in return. That promise is the foundation the entire system rests on. So when the Treasury made a sudden unannounced move to buy back its own bonds, it sent a quiet signal to the market. Something under the surface needed attention. At first, the plan seemed to work. The long-term bond yields fell right after the announcement. Traders reacted the way the Treasury hoped they would. Calm returned, at least for a moment. But by the next day, something strange happened. The bond yields crept right back up. Whatever the Treasury tried to fix, it had not stayed fixed. The pressure simply returned. And it was in this exact moment, while the bond market struggled to hold its calm, that gold began to move. Gold is often described as the asset people run to when they are afraid. Fear of war, fear of inflation, fear of a falling currency. But this time, the fear looked different. It was not fear of a single event. It was a quieter, more uncomfortable fear. A fear that the system managing the world's money was starting to strain under its own weight. As the bond market wobbled, gold began climbing. Slowly at first, then faster. It moved past $4,500, then it kept going. Within days, it crossed $4,600, a level many analysts did not expect to see so soon. This was not supposed to happen this way. When a government takes strong action to calm its own bond market, investors usually feel reassured. Confidence is supposed to return. Riskier assets are supposed to look more attractive again, and safe havens like gold are supposed to lose some of their appeal. Instead, the opposite happened. Investors watched the Treasury try to manage the situation, and instead of feeling reassured, some began asking a harder question. If the government needs to step in and manage its own bond market this directly, what does that say about the size of the debt itself? This question is not really about interest rates. It is about trust. Trust in whether debt this large can keep growing without consequences. Trust in whether promises made decades ago can still be kept today. And once that kind of question starts spreading among investors, it does not stay contained to one corner of the market. Bond traders felt it first. Currency traders felt it next. And gold, the asset with the longest memory of all, absorbed it immediately. What makes this moment different from past ones is timing. This is not happening during a war. It is not happening during a stock market crash. It is happening quietly in the middle of ordinary trading days, while officials insist everything is under control. But history has shown, again and again, that the biggest financial turning points rarely start with alarms and headlines. They start exactly like this: a quiet policy decision, a market that does not respond the way it should, and a slow, steady shift in where trust decides to go next. By the end of the week, the numbers told a clear story. The Treasury had acted, the bond market had not fully settled, and gold had done something it was not supposed to do this soon. It did not wait for permission. It simply moved. And that single, quiet move raised a much bigger question, one that would only grow louder in the days that followed. Every story eventually reaches its true center. For this one, the center is a single number: $40 trillion. That is how much the United States government now owes. It is the largest debt figure in the history of any nation on Earth. And this week, it officially crossed that threshold. Numbers this large are difficult for most people to picture. A trillion is not just a bigger version of a million. It is 1,000 billion stacked together. 40 of those, one after another, now sit on the books of the federal government. And unlike a company that can shrink, restructure, or shut down, a government carrying this much debt cannot simply walk away from it. What makes this moment different from past milestones is not just the size of the number. It is who else is borrowing money at the exact same time. For years, the government has been the biggest borrower in the room. Everyone else adjusted around it. But recently, a new competitor has entered that same room, and it is borrowing on a massive scale too. Large technology companies, racing to build the infrastructure needed for artificial intelligence, are taking on enormous amounts of debt of their own. Data centers, computing power, and energy supply all cost staggering amounts of money, and these companies are turning to the same lenders the government depends on. This creates a problem that sounds simple but carries serious weight. There's only so much money available to lend at any given time. When two enormous borrowers, the government and private industry, both need massive amounts of capital at once, the price of borrowing goes up for everyone. That price shows up as rising bond yields. A well-known market strategist described this dynamic clearly. He explained that this growing competition for capital is exactly why yields have been climbing and why investors are suddenly paying close attention to something they used to ignore. For years, interest rates stayed low enough that most people stopped thinking about them entirely. Now, rates are moving in a way that feels unfamiliar, even alarming, to a generation of investors who never experienced anything different. Here lies the uncomfortable truth sitting underneath this entire situation. The government cannot easily handle a world where borrowing becomes more expensive. When debt is this large, even a small increase in interest rates translates into a massive increase in what the government must pay just to service that debt. Money that could go toward other priorities instead goes toward interest payments alone. One financial expert put it plainly: the country has taken on so much debt that it can no longer afford to see interest rates rise significantly. Not because higher rates are unusual in history, but because the sheer size of today's debt makes even modest increases dangerous. What might have been a manageable shift 20 years ago now carries far greater consequences. This is where gold re-enters the story, not as a reaction to fear or panic, but as a response to arithmetic. Investors are not necessarily predicting a crisis tomorrow. They are recognizing a structural problem that has been building slowly for years and is now becoming harder to ignore. A government this indebted, competing for capital against fast-growing private borrowers, creates pressure that does not resolve quickly or quietly. Some officials argue this pressure is temporary. They believe that heavy investment in new technology will eventually boost productivity so much that it offsets today's borrowing costs entirely. Growth, in their view, will outrun the debt. Other analysts see it differently. They believe this competition for capital is not a short-term phase at all, but the new normal, a lasting shift in how money moves through the economy. Two very different outcomes, two very different futures, and no way yet to know for certain which one is correct. What is certain is this: gold does not seem to be waiting around for that debate to be settled. Its recent rise suggests that a growing number of investors would rather hold something outside the financial system entirely than bet on which version of the future turns out to be true. The debt is no longer a background detail mentioned briefly in news reports. It has become the force quietly shaping bond yields, currency values, and investor psychology all at once. And as the next part of this story reveals, the debt itself is not the only signal worth watching. Something else, far less discussed, has been happening at the exact same time. Something involving trust, currency, and a very unusual movement of a metal most people never think about. While the bond market absorbed all this attention, something quieter was happening to the US dollar. And in some ways, this quieter shift may matter even more than anything happening in bonds. A government can manage its own debt in several ways. It can buy back bonds, as the Treasury just did. It can adjust how much it borrows and when. It has tools, choices, and levers it can pull. But a currency is different. A government cannot simply announce a plan to buy back its own currency the way it buys back bonds. Confidence in a currency is not something that can be manufactured overnight through a single policy decision. This week, a widely followed measure of the US dollar fell to its lowest point in 3 months. This happened during the very same days the Treasury was working hard to stabilize the bond market. Bonds, at least on the surface, showed signs of calming. The dollar did not. It kept sliding. This distinction matters more than it might first appear. Bonds are a promise to repay a specific amount of money at a specific time. A currency is something different. It represents trust in an entire economic system, built up slowly over generations. Bonds can be managed with a phone call and a policy announcement. Trust in a currency cannot. While this was unfolding in currency markets, an unusual pattern was also developing in a market most people never think about: copper. Copper is not usually thought of as an emotional asset. It doesn't respond to headlines about war or elections. It responds mostly to industrial demand, construction, and manufacturing. But this week, analysts noticed something they had never seen before. A huge share of the world's available copper, sitting across major exchanges in New York, London, and Shanghai, was now concentrated almost entirely in the United States, nearly 70% of it. Here is what makes that number strange. The United States only accounts for roughly 7% of global copper consumption. In other words, a resource used mainly by the rest of the world was piling up in a place that barely needs it. According to analysts who track this closely, almost none of that copper has left the country once it arrived. It moved in ahead of anticipated trade policy changes, and now appears stuck in place. This creates what one strategist called a stranded metal. copper that isn't being used where it sits, while the rest of the world quietly faces tighter supply. And copper takes years, not months, to bring new mining production online. There is no fast fix for this kind of imbalance. At first glance, currency weakness and a copper supply shift may seem unrelated, but both point toward the same underlying idea. Physical assets, real things with real scarcity, are behaving in ways that suggest deeper uncertainty about the systems built on top of them. Currencies represent trust in institutions. Copper represents trust in supply chains and industrial stability. When both begin behaving unusually in the same short window, it becomes harder to treat either one as a coincidence. One analyst summarized the moment in a simple, memorable way. He said that copper right now represents a shortage of physical supply. Gold represents a shortage of something less visible but just as real: trust. This week, he noted, both shortages grew worse at the same time. This is the deeper thread now connecting bonds, currency, and even industrial metals. It is not simply about interest rates anymore, or a single Treasury decision, or one unusual week in the copper market. It is about whether the tools governments have always used to manage confidence are still capable of doing so in a world this indebted, this interconnected, and this uncertain. The bond market can be nudged. The currency cannot be forced. And gold, sitting quietly above $4,600, appears to be pricing in exactly that difference. What comes next depends on decisions still being made in the coming days, inside institutions most people will never see directly. And that is exactly where this story turns next.